at you with a pretty quick video. As you can see, we had CPI come in today, and come in a tiny bit below the mark. So we should see a little bit of bearish impact, if no impact at all. This could have been priced in already um, over the past few weeks. If you're familiar with information trading or high impact trading, typically this news is able to be predicted a few weeks out to a week out and can kind of be priced into the market beforehand, which is why you can kind of see less of a volatility move around that data release, or sometimes um, a move in the opposite direction of where you would think that information would cause the market to move as kind of a fake out before that continuation. Anyways, the point of what I was wanting to talk about today is I know a lot of traders are familiar with um, high impact news and high volatility sessions due to this news, and have learned to either trade with the news by understanding how its impacts will happen for certain events, such as CPI, PPI, what else do we have? Job claims, jobless rate we had yesterday, unemployment claims, or jobless rate was the day before, yeah, from employment change, average hours, unemployment rate. Those things you can all utilize for informational trading. However, what I think a good piece of people are going to do, CPI is price inflation. I've just read this comment and I'm realizing I'm stupid. So lower price inflation means we saw a decrease in the increase of prices in that rate. So we might be bullshit a little more longer, but that could have already been priced in. So I'm not really caring about the news. The point that I was trying to make with this video, off the rip, is these things are important, and they're important. They're important because yesterday when we talked about, or 2 videos ago when we talked about portfolio management, these institutions are forced to manage around these events because these events have macro impact. However, these events do not matter in your directional bias setting on a day-to-day basis or a session basis after the fact, or to a certain extent before the fact. And what I mean is, if CPI is expected to be 0.1% lower, then, or it comes in 0.1% lower than the census forecasts, and institutions know that, that is not a crazy enough difference to have been the deciding factor of directional movement the past few days. What is a directional factor is risk-free rate, bond yields, and some calendar action. And what I mean by that is the risk-free rate, which is the theoretical rate associated, or the arbitrage rate associated with a stock under the assumptions that there is zero risk with that stock, and that stock obtains the consensus investment and value. What that means is, if I have a stock of Apple, it'll retain the market census investment and have zero risk. This is most this is most visualized in 10-year yield bonds. They tend to be the most accurate and reflective of this risk-free rate, which is why, although central banks determine these bond yields and this risk-free rate, that to a degree, that these banks have a lot of the control over directional movement, because them coupled with dealers, market dealers, have a certain limit to balance sheet, have a certain forecast of all assets under a risk-based system, where we reference risk-free rate, which means if tech is up 5% and has a dominance on the market of 30% weight, and the risk-free rate is 2%. Well, unless every other sector, the 75% of sectors, can account for that weight difference, largely we are going to expect a tech pullback to come meet that risk-free rate, because these market dealers and banks do not have enough supply on their balance sheets to allow for greater directional movement. These manager systems, high frequency traders, options traders, and hedge management companies, they must abide by the balance sheet rules of market dealers and banks because that is who finances their position sizing and allows for them to enter and exit into trades. That is where liquidity depth is provided and volume is provided. Without those things, very little trading can actually be done, which sets the amount of volatility you can see, which, when you understand risk-based trading and understand that these institutions are likely either looking to keep price around a volume-weighted average to get rid of risk, or when time needs it and positions must be adjusted, they must be adjusted with the knowledge that there is either a lot of ability to adjust, where that rate is rather high and all investments seem to have a pretty decent return, that induces spending and induces bullish activity within the stock market. But one thing I want to bring up again is it's not so much activity as it is the ability to supply volume, right? And what that means is, right, we can have, right? We can have, okay, no volume that goes against this bullish line, right? So we're gonna have is little high frequency trading and no resistance against this management system, okay? When I was saying a higher risk-free rate will lead to more bullish markets, what I was not meaning that. So I apologize for saying that. What I was meaning was there's going to be higher volume, which allows for more money being put in, right? If we have low volume, all right, and then we have a 50-point move or a 20-point move, it is going to have a very weak correction, right? Where of that day seeing that correction, managers are likely going to have to sit out and simply let the trend continue. However, if we are in a high volume market where this same 50-point move can then be easily retraced with a 15-point move, then what we'll likely just have is chop. And there's nothing technical about this. There's nothing fair value gap seen or order block seen. What this is going, okay, how much money can we expect to be utilized as, or how many assets can we expect to be utilized as trading volume today, given overall macroeconomic conditions, right? What is current foreign policy looking like? Are we expecting more money in the coming months or less money in the coming months, and why? And then how much money are market dealers able to provide to these hedge managers and portfolio managers? How much volume is actually able to be traded, allowed by banks and allowed by these managers, instead of, well, we gotta do this because of this gap. No. And so I want to make this video really quickly, just saying that utilizing certain immediate news forecasts is useful if you want to trade off of those news spikes, if you understand how certain macroeconomic immediate releases impact the market and impact price action immediately. If you understand that to a good degree, keep doing it. Keep doing it. You're probably right. Maybe that system breaks. But it's not going to break, or it's not going to work for any reason of you being a genius. But it also won't work because you're an idiot. If you understand the repetitive system that for some reason is seen by these percent changes of that event, keep trading it. So clearly you know something that is working. Or maybe say tighten up your stop losses or one or two things, but but stay to that. If that's working for you, I don't trade news, but if that's you, then keep at it. Um, so real quick, I want to talk about the yield curve really quickly. So this is honestly all we need to focus on. This par yield curve, which relates the par yield on a security to its time to maturity, is based on the closing market prices on the most recently auctioned treasury securities in the over-the-counter market. Par yields are derived from input prices, which are the indicative quotations obtained by the Federal Reserve Bank of New York at approximately 3:30 p.m. each business day. What does it mean? This is the banks trying to establish some element of a risk metric for a theoretical passively invested stock, which can be used to a high degree of merit to approximate daily activity and the size of these balance sheets that the banks and these market dealers are going to be able to have on that day, on that week, etc. Um, yeah, I feel like these videos that I'm doing are very much snippets of not a full system. But I know that if I do a full system video without like a script, I'm just gonna go off on my tangents because I'm already going off on my tangents with these smaller videos where I'm not even really discussing anything. But then I keep thinking, I don't know. I guess when people start seeing these and they can comment like, "This is why you're stupid. This is why you're not doing it right or wrong." Y'all can comment that, right? If anyone sees these videos and they're like, "Well, you seem maybe a little smart, but you're talking like a moron," well then just let me know and I'll fix my and adjust my system. But I'm just kind of trying to make um videos about what I know and what I think is different and what people should kind of take a look at. This is all accessible on the treasury.gov website, by the way. Like all that information is public. Some options information I don't think you can get unless you have like an open source supply of data. But yeah, I don't really know if that even exists. There's some like free trials, but I don't think you can really have one with very easy access. Anyways, thank you for tuning in. Um, understand why high impact news is used and why positions need to be adjusted with it, but that is not overall the set of the market, and that even though what we discussed today of bond yields and balance sheets being allocators for investment, they have impacts on trend setting and direction setting. They do not decide themselves the direction. Those are other factors such as microstructure, which allows for position taking at certain efficiency levels. That is what sets directional pattern in adjacent with yield and bond rates. But we'll get to that in another video. We'll talk about how microstructure um, sets position adjustment in portfolio building, and also we'll talk about hedge funds and active management. But for now, we're just gonna talk about some news stuff, and I'll catch y'all on the next one. So, yeah.